Welcome back to Positions Taken, where every call is backed by data, not noise. Let's break it down. Most beginner investors make the exact same mistake. They chase high dividend yields. They see an 8% or 10% yield, buy the stock, and then panic when the share price crashes and the dividend gets cut. If you want to build actual sustainable wealth, you need to stop chasing high yields and start focusing on dividend growth. Today, we are breaking down the 3 absolute best dividend growth ETFs that you can buy and hold forever. These are funds that hold high-quality companies with a proven history of paying you more money year after year. Let's get into it. Before we name the funds, let's talk about why dividend growth is the ultimate cheat code for investors. When you buy a company that increases its dividend every single year, your yield on cost goes up over time. Imagine buying a stock at $100 that pays a $3 dividend. That's a 3% yield. But if they double that dividend over the next decade to $6, and you still only paid $100 for your original shares, you are now earning a 6% yield on your initial investment. Plus, companies that can afford to raise their payouts constantly are usually incredibly stable, cash-generating machines. They survive recessions, they beat inflation. Now, let's look at the ETFs that do all the heavy lifting for you. First up on the list is the undisputed heavyweight champion of the dividend community, SCHD, the Schwab U.S. Dividend Equity ETF. If you spend any time on financial YouTube or Reddit, you have heard of this one, and for good reason. SCHD tracks the Dow Jones U.S. Dividend 100 Index. It doesn't just look for companies that pay dividends, it filters for quality. It demands at least 10 consecutive years of dividend payments, and then screens for cash flow to total debt, return on equity, and dividend growth rate. It's basically a quality control machine. You get a solid starting yield, usually hovering around 3.5%, and an annualized dividend growth rate that has historically been in the double digits. It's the perfect balance of current income and future growth. Coming in at number 2 is VIG, the Vanguard Dividend Appreciation ETF. If SCHD is the balanced hybrid, VIG is the pure growth play. VIG tracks the S&P US Dividend Growers Index. To even be included in this fund, a company must have a track record of increasing its regular annual dividend for at least 10 consecutive years. Vanguard also excludes the top 25% highest-yielding eligible companies, which is a brilliant safety mechanism to keep out yield traps. Because it focuses so heavily on appreciation, the starting yield is lower, usually around 1.8% to 2%, but the capital appreciation of the actual share price has historically beaten out many higher-yielding peers. This is the ETF you buy in your 20s or 30s when you have decades to let the compounding snowball roll. Our third pick is DGRO, the iShares Core Dividend Growth ETF. DGRO is uniquely structured. It requires 5 years of uninterrupted annual dividend growth, which is a slightly lower bar than SCHD or VIG, allowing it to capture younger tech and healthcare companies that have just started heavily returning capital to shareholders. The secret sauce of DGRO is that it excludes companies with payout ratios above 75%. That means it only buys companies that are paying out less than 3/4 of their earnings as dividends, ensuring they have plenty of cash left over to reinvest in their business or weather a bad economy. It yields around 2.3% and offers a fantastic blend of old-school dividend payers and newer dividend growers. If you want to build a bulletproof portfolio, blending SCHD for its starting yield, VIG for its capital appreciation, and DGRO for its broad diversification is an incredibly powerful strategy. Remember, the magic of dividend investing only works if you turn on DRIP, Dividend Reinvestment Plan, and let those dividends buy you more shares automatically. Which of these 3 ETFs is your favorite? Let me know down in the comments. Hit the like button if you got value out of this, subscribe for more market analysis, and I'll see you in the next trade.